growing consensus is that environmental, social, and governance considerations are closely aligned with a company's potential for sustained growth. This is especially pertinent for credit analysts, who are increasingly weaving ESG factors into their evaluation frameworks. ESG factors are recognised as pivotal risks and opportunities that have a profound influence on a company's long-term performance and its competitive edge. Many aspects of ESG have long been topics within the scope of credit analysis. However, they have not often been specifically highlighted. As such, these factors are at the heart of traditional financial risk analysis, and their assessment is crucial for a comprehensive understanding of a company's financial health. Incorporating ESG into credit analysis does not require a fundamentally new approach. Rather, it complements each stage of the credit decision process, involving the explicit and systematic inclusion of material ESG factors into each step. To determine the true credit risk presented by such ESG factors, an analyst needs to assess how important and relevant their effects may be, and if they are sufficient to change the credit profile or influence the credit decision, and if so, how. Analysts need to determine their effects on a company's business model and value drivers, such as operating revenues, capital expenditure, or profit margins when undertaking a credit analysis. The material impact of ESG factors on creditworthiness varies, with risks and opportunities often manifesting over a longer timeframe than traditional credit considerations. The Sustainability Accounting Standards Board has developed a materiality finder tool, which identifies material sustainability issues on an industry basis alongside the accounting metrics that may be affected, and suggests where to find relevant quantifiable information in a company's annual report. There is no single universally accepted approach for the integration of ESG into the corporate valuation process. However, valuation models such as discounted cash flow, valuation ratios, and risk-return assessments can be used, with adjustments made for quantifiable and non-quantifiable ESG factors. The information gathered is consolidated and scored to gauge a company's ESG performance. This scoring process equips credit analysts with a means to assess the qualitative aspects of a company's operations, thereby enabling more informed investment decisions and improved risk management. However, challenges persist in integrating ESG into credit risk analysis. Disparities in corporate disclosure practices and the absence of mandatory reporting standards in many countries can result in incomplete ESG data and data shortfalls. Some market participants do not have the resources to undertake comprehensive primary research on ESG factors, so they employ ESG rating agencies to provide and assess the relevant data. However, the diversity of methods and the assessments employed by various ESG rating agencies can complicate data comparability. On the plus side, these areas are advancing due to pressures from regulators, investors, and society at large, who demand better management and disclosure of ESG risks. Incorporating ESG factors into credit analysis is transforming the financial landscape, offering a more thorough understanding of a company's risk profile and growth opportunities. This allows credit analysts to make more enlightened and sustainable credit decisions and investment choices. As the market becomes increasingly attuned to global challenges like climate change, resource scarcity, and social disparities, the resilience of a company's business model in addressing these issues is crucial. Analysts who can pinpoint companies that proactively manage their ESG risks are likely to identify those that are not only financially sound, but also conducive to a more stable and equitable global marketplace. The evolution of ESG in credit risk analysis also signifies a shift in investor expectations. Investors are increasingly demanding that their capital not only yields financial returns, but also drives positive change in terms of environmental stewardship, social contribution, and governance integrity. Credit analysts therefore play a critical role in fulfilling this investor demand through integrating ESG factors into their credit assessments.